Morning students. In today's class we'll see the concept and admission of partner. Here, according to section 31 subsection 1 of Indian Partnership Act 1932, a person can be admitted only with the consent of all existing partners. Number 2, a person who is admitted to the firm is known as an incoming or a new partner. Number 3, on admission of a new partner, the existing partnership comes to an end and a new partnership comes into effect, or new firm is reconstituted under the fresh agreement. Whenever a partner is admitted into partnership firm, he acquired two rights. These are two important rights: the right to share the assets of the partnership firm, right to share the future profit of the partnership firm. The amount that a new partner brings in for the right to share in the partnership assets is called his capital, and it is credited to his capital account. Whereas the consideration which he pays to the old partners for the right to participate in the division of future profit is called goodwill. While admitting a new partner, we have to take care of the following adjustments. Number 1, recording the capital of a new partner. Number 2, calculation of new profit sharing ratio and sacrificing ratio. Number 3, revaluation of assets and liabilities. Number 4, transfer of undistributed profit or loss. Number 5, transfer of accumulated reserves. Number 6, treatment of goodwill. Let us see one by one. First one, recording of capital of a new partner. It is not compulsory that the new partner brings his capital at the time of admission. He may be admitted in view of his talent, skill, and reputation. In many cases, the incoming partner brings capital into the firm, which, with the consent of all the old partners, he brings capital in cash or kind or both. The accounting treatment will be: if he brings cash account data to new partner's capital account. He brings stock to new partner's capital account. Furniture or any other asset, furniture account or any other assets account data to new partner's capital account. Number 2, the calculation of new profit sharing ratio. Here, to calculate the new profit sharing ratio, when a new partner is admitted, he acquires his share of profit from old partners. This reduces the old partner's share of profit. Hence, the new profit sharing ratio for old partners have to be calculated. A new profit sharing ratio, the ratio in which all partners, including the incoming partner, share the future profit or losses in, is known as the new profit sharing ratio. The determination of new profit sharing ratio depends on the ratio in which incoming partner acquires his shares from the old partner. The new share is equal to old share minus of sacrifice. Let us see the sacrificing ratio. The ratio in which the old partners have agreed to sacrifice their share in profit in favor of a new partner is called sacrificing ratio. The formula for the sacrificing ratio is equal to old profit sharing ratio minus new profit sharing ratio. Sacrifice is equal to old ratio minus new ratio. The purpose of this ratio is to determine the amount of compensation, that is goodwill, to be paid by the new partner to the old partner for his share of profit surrendered. So, while admitting a new partner, old partner have to forego their profit on behalf of their incoming partner. For that, the compensation will be paid. That compensation is called goodwill. Here from the calculation point of view of sacrificing ratio, the following are the different situation. So let us see the situation one by one. First is main heading situation. When new share of incoming partner is given, then sacrifice of the old partner are not given, then the sacrifice in the old ratio. Unequal sacrifice of old partners, then unequal sacrifice. Equal sacrifice of old partner, then it is equal sacrifice. Entire sacrifice by one partner. So these are the different situation comes under heading number 1, whereas we'll move on to number 2. Second situation, when the new partner share, the new share of incoming partner is not given, then sacrifice of old partners are given. Third situation, new profit sharing ratio is given, then when the new share of incoming partner is given and sacrifice of old partners are not given, sacrifice in the old ratio. Then we comes to the main part where revaluation of assets and liabilities. At the time of admission of a partner, the assets and liabilities are revalued so that the profit and loss arising on account of such revaluation may be adjusted in the old partner's capital account in their old profit sharing ratio. Since before we admit a partner into our partnership firm, we have to revalue all the assets and liabilities. Any gain or loss or any profit and loss derived through revaluation of assets and liability will be shared among the existing old partners in the old ratio. Next, we'll move on to the revaluation account. To prepare a revaluation account, so as usual, revaluation account format debit, credit, etc. Here the shortcut for preparing the revaluation account is very simple. When the value of assets increases or the value of asset decreases, when the value of liability increases and the value of asset decreases, it is debit. When the value of asset increases or the value of liability decreases, then it is credit. Again I repeat, the value of liability increases and the value of asset decreases, you have to put it debit. And the value of asset increases or the value of liability decreases, we have to record on the credit. Unrecorded liability, if now recorded, we'll put it on the debit side. Unrecorded asset, now we have recorded, then we'll put it on the credit side. Creation of new liability, we'll put it on the debit side. By this way we'll prepare the revaluation account and find out the profit or loss arising out of revaluation. Now the next heading is transfer of undistributed profit. As you all are aware, the balance sheet of the partnership firm may show undistributed profit in the form of profit and loss account and in the liability side. The undistributed loss in the business are generally shown on the asset side of the old balance sheet. The new partner is not entitled to have any share in the undistributed profit or loss. Undistributed profit and loss should be transferred to old partner's capital account. So, any profit or loss already existing in the old balance sheet must be transferred to old partner's capital account in their old ratio. For transferring undistributed profit and loss account data to old partner's capital account. Now, for transferring loss, it is a reverse entry of previous entry, that is old partner's capital account data to profit and loss account. Let us go to the reserves, general reserves, reserve fund, contingency reserves. Here, the partners of the firm may set aside a portion of percentage of profit earned to needed the unexpected, to meet the unexpected and unforeseen losses arising out of future in the name of a reserve. So we keep it as a reserve. The reserves are created out of profits. So reserves are created out of profit. From every year's profit, a percentage of the profit is kept aside as a reserve, either as a general reserve or revenue reserve or contingency reserve or any other specific reserve. At the time of the admission of a partner, of a new partner, there is, if there is any reserve, it should be transferred to the capital account of the old partners in the old profit sharing ratio. The accounting treatment for transferring any reserves are, if it is a reserve fund account data to old partners capital account, or any other reserve. So, and the particular reserve account data to old partners capital account. Next, very important is treatment of goodwill. So goodwill is the result of old partners' efforts in the past. So old partners, they have put their efforts to earn profit continuously and running the firm successfully. So at the time of the admission of a new partner, the goodwill is to be adjusted in the old partner's capital account. You all know, when a successful business is there, nobody wants to start their new business if they know, if there is an opportunity to join with their existing business so that they can earn immediate profit. In spite, if they start a new business, it will take time. So the goodwill can be adjusted in the following three methods: revaluation method, memorandum revaluation method, premium method. Now let's see the revaluation method. Under this method, the new partner does not bring in cash for his share of goodwill. The goodwill is raised in the books of the firm. Goodwill does not appear as an asset in the balance sheet, though it exists in the firm. It means that it is not yet recorded in the books and remains silent asset. At the time of admission of partner, goodwill is raised to its present value and shared by the old partners in the old ratio. The entry will be goodwill account data to old partners capital account. Next, goodwill appears in the books of account. So understated. So goodwill appears in the balance sheet of the old partners at a value lesser than the present value. So it is called understated value. Then the difference between the present value and unrecorded amount of goodwill is transferred to the old partner's capital account in the old ratio, that is goodwill account data to old partner's capital account in case of increase in the value of goodwill. If it is in case decrease, reverse entry, old partner's capital account data to goodwill account. So goodwill appears in the books. If it is overstated, the second entry must be passed. Next, we'll move on to the valuation of the goodwill in the next video. I hope you have understood the concept. Finally, we are going to move into the admission of partnership problems in the next video. Before we'll wind up the valuation of goodwill. Thank you.